Ever notice how the market can stop you out and then immediately go in your direction? That's not a coincidence. It's liquidity hunting. But it's not the monster you may have been taught to believe it is, and you can learn to use it to your advantage. Institutions need your stop losses to fuel their moves, and they know exactly where you're placing them because retail traders tend to place their stops at really obvious places, just like sitting ducks. I'm going to show you how to identify where these liquidity grabs are happening and how to trade after that institutional trap is set, not during it. This one shift could be the difference between consistently losing and finally trading with the institutional money. Size, liquidity, and participation are open interest and volume. How many contracts are open and how many are being traded. We won't always know who, but size does mean attention and it means dollars. Usually lots of them. If we don't see the size, it's like crossing the street and not looking both ways first. When taking a day trade in the SPX just the other day, the volume was high at a specific level. It created support about 15 minutes into the cash close. And guess what price did? It rallied off this support level, represented by size. 80-cent SPX call went to $4. That's what size can do. And this happens 55 to 60% of the time each month. Size via volume can be support and resistance. Open interest into expiration can be support and resistance. Sadly, for far too many traders looking at price alone, they miss this liquidity and they take poor trades. Basically, they're uninformed. Here's what liquidity really is. Levels where big players executed past orders. It's size, and it acts like footprints from large transactions. Support and resistance. Institutions require specific zones to get filled. Think point of control, think anchored volume-weighted average price. This is why institutions hunt for counterparty volume. They need buyers for their sells, they need sellers for their buys. Stop hunting may sound insidious, as if the market is out to get you. I have never made a trader who starts each session thinking this. The best traders are highly optimistic. Retail traders place stops in predictable locations. These swing points, previous day levels, clean highs and lows are usually what most gurus will tell you to look at. But if everyone is doing that, that leads to a ton of orders at that level. The key is to use these levels and not get stopped out by it. Stops accumulate at obvious levels within structure. We'll talk about that in a bit. Obvious equals predictable size for a liquidity sweep. Think massive orders being filled. Think of the last time you saw price approach a major psychological level. And those are simply price levels that end with 1, 2, 3 or more zeros. Did it break the first time and keep going? Or did price reach that level, rally just a bit beyond it, and then sink right back into the range or pull back in a trend? That is a liquidity sweep. It fills the orders at the obvious levels, and without more size waiting above, price does not have support, and price certainly doesn't have momentum. This is how price interacts with liquidity zones. Prices spike into the predictable zones. This triggers usually momentum buyers who, for them, this is a breakout. This is something that they expect will continue. And often many of these Momo traders find out that it does not on the first attempt anyways. Real moves begin after the sweep. The orders are filled, price sinks back down to another high volume support level, and then it rallies from that only to continue through the level, perhaps on the second or third attempt. By then, average retail traders have already been stopped out. And then they think, oh, the market is out to get me. Actually, no, but the market needed size, and that is where the price went. A mentor of mine said this simply, and I believe this to this day. The market moves in the direction of the most stops. But why? Institutions, banks, funds, corporations, they're not trading 100 or 1,000 shares. They are buying and selling tens of thousands of shares, and that needs size. When you think about the market, think of it as a place to match buyers and sellers. Traders from the 90s probably remembered ECNs, or these electronic matching networks that aggregated orders from traders, brokers, and institutions, and then automatically paired them. It paired the compatible buy and sell orders in real time. The market was not out to get you. The size was there, and your order was just part of the match. You don't blame a shark for swimming into a school of fish any more than you blame institutions for looking for a large group of orders. Here's an example of a retail trap. You can often see the signs once you know what to look for. Multiple taps or tests form equal highs and lows. Price keeps feeding off that pool of orders until the trade size is complete. It looks like strength or a breakout, but actually it's a target. Sweeps happen as retail traders get trapped in the order fills, thinking that the trade is about to start, when in reality, it was not a breakout. The resistance held, and they often will step back and say, well, that was a whipsaw or a false breakout. So what's the easiest way to spot these traps? We now know that these levels are just order flow, but the reason it hurts so many traders is that they get the direction wrong in the timing. The easiest way to spot these traps, and here is what average retail traders unfortunately do. The first thing they do is they don't understand the psychology behind the inducement, that temptation to get in the position. The market creates a false sense of urgency. Now, often this is going to accompany a data release, think non-farm payroll or GDP or CPI, or news or some sort of rumor. The move appears quickly and often looks like it's going to absolutely blow through resistance. It often does. And this then means to those momentum traders that a bigger move is happening. This encourages chasing, and the fills are usually awful because traders will use market orders to scramble into the market. Here's the second issue, the near miss phenomena. Price stops and reverses quickly after that initial burst of action. But why does it do this? Because without more buyers willing to buy at higher highs, the momentum ends. That liquidity to the upside evaporates. It looks like an early supply or demand move, but the buying in reality was just getting swept up in the volatility of that liquidity sweep. It only looked like a breakout, but it had no reason to continue, and it had no size to continue. Traders jump in without having zones or levels to enter from, and usually those traders are lacking a plan. Here's why chasing entries and traders with no plan get punished the worst. Stops become tighter and easier to grab, more liquidity. This is especially true with previous day highs, previous day lows, and closes. Institutions exploit these tight and predictable clusters of orders. The trap forms before the real move or continuation. So what is the trap then? It's the obvious price zone that most retail traders are taught are trade setups. So here's the classic trap sequence. It's an early bounce to the sweep at a liquidity level. The pullback then follows, where a lot of retail traders get stopped out. After that, the follow through in the real direction then occurs, but only after retail traders get flushed out, stopped, and then they think the market's out to get them. In reality, institutions enter at optimal prices using volume. They want to know where the anchored volume weighted price is. They're looking at volume profile. They're looking for where that size is. And remember, they need size to simply do their job, which is to fill orders many times on behalf of clients. Now, there's a lot of historical precedent to this. These are not new concepts. Study history. Study great traders with verified multi-decade success. Many new concepts actually just mirror old trading patterns, like a Dow 123, which is a classic false breakout to pullback entry. Classic candlestick patterns, like inside days, also known as haramis, three soldiers, three crows. These have been around literally for 1,000 years, but they get renamed and traders think they're new. Similar to Linda Raschke's turtle soup setup, where momentum emphasized, but the pullbacks are the true entry. This is what she determined after noticing these liquidity sweeps after the classic turtle setup, and she created the turtle soup. Both Dow and Wyckoff based their entries from market structure, bullish, bearish, or chop. Understand that first, and then look for levels within the market character. This works across any market in any time frame. And by the way, time frames are self-imposed limitation. There is no magical time frame, only price, size, and ultimately order flow. Amateurs wait for the candle to close. Experienced traders wait for price sweeps and then enter in their predetermined zones. So here's how to trade inducement the simple way. And think about it. Inducement is what? It's a level that looks attractive, but it may not be really what's happening. Earlier, I mentioned one of my setups using time, the last 15 minutes of the cash session, and then looking for levels with size from which the market could find support and bounce off of, moving the market higher. This is not a one-off phenomenon. It's the heart of all my setups. Find the levels, wait for the sweep, take advantage of the post-sweep support or resistance. Here's another example. Just a handful of months ago, gold finally broke from a narrow range and began to trade higher with increasing volume. And very soon after, a trend organized with higher highs and higher lows. And by the way, in an uptrend, focus on the higher lows or the support of the trend because that is the backbone of the move. And that will be frequently bought into when new highs and ultimately sweeps that happen at those new highs trigger a pullback or a retracement. Following the pattern of sweeps at the new highs leading to pullbacks to the backbone of the trend over and over again created one of the biggest wins for me this year in gold. This translated to gold, gold futures, the GLD ETF, and even gold miners. This is something I did live with traders in my Sector Secrets Mastery. So here's what tends to happen in strong uptrends, and this often causes traders to lose or take way too much risk. So let's talk about it. First thing, they buy into higher highs with a tight stop. And when the market pulls back after a sweep, they get stopped out only to watch the market move back higher without them. The second thing they do, and this is far, far worse, they think the market has gone too far, that it's too high, and they begin to short into the highs, which actually momentarily looks like it's working when those sweeps occur. And then the trend resumes much higher, stopping them out. How to trade inducements the simplest way possible just needs a few steps. The first step is find the liquidity. Where is the size? Identify those clustered stops. Look for the new highs, previous day highs, lows, and the close. Use volume profile. My favorite is the point of control. And by the way, you can automate this on TradingView. I'll look for the point of control for the year, for the quarter, and I'll do this on a daily chart. These levels can also be used intraday. So you can use a point of control on a 5-minute chart for the session. I like anchored VWAPs as well. I will anchor it the first trading day of the year. You can also anchor from the quarter, and you can also anchor from earning releases. Intraday, I'll anchor a volume weighted average price or VWAP to 7 a.m. Eastern when I'm day trading. The second step, identify your point of interest. Zones where institutions will act because there's size. Remember, volume means liquidity. And for expiration on options, this can be open interest, and these can act as magnets to these high open interest strikes. Inside candles, 3 soldiers, 3 crows. These will often be what are commonly called breaker blocks and fair value gaps. I prefer discounts for longs and premium for shorts. What that means is I want to pay as little as possible when I'm buying a call, but I want to collect as much as possible if I am selling a call. Here's a third step. Wait for the sweep, aka the false breakout, and then the pullback to support. Remember that concept of the backbone? That's what we're waiting for. Don't enter during the grab. Don't enter at the highs. Wait for the sweep, the rejection, and then the pullback to support. The confirmation of this sweep allows us to avoid being the liquidity and taking advantage of it. Here's a practical example in NVIDIA. Mark the highs and the lows near current price. Identify an order block discount. You can use volume profile. You can use an anchored volume weighted average price. Then wait for the sweep and the pullback confirmation. This is the framework behind a 100-year time-tested approach, and it still works in modern day with modern day liquidity. After more than 3 decades of trading, I can tell you there is seldom anything new in trading. In reality, there are just 4 factors that move the market. Price, time, volume, and volatility. And you and I, we can track these. The trick, if you want to call it that, is to make sure you're tracking all four. Most traders just look at price indicators and price levels. That means they're only looking at the market in one dimension rather than four. Ultimately, the 100-year framework behind modern liquidity is really about what has always worked, what has stood the test of time, what is actually now so old that it's new again to a brand new generation of traders. So let's talk about what some of these are. SMC, or smart money concepts. These are old concepts with a new terminology, and that's fine, right? It tends to mirror Dow, Wyckoff, Raghee, Japanese candlestick patterns. Same principles, different labels. And again, that's okay. But when you know the real history of a strategy, you can see for how long it has worked effectively. You can study decades of data and practice while learning from them. This is how I learned to be a trader. I was a student of history. We all stand on the shoulder of giants who often traded 50, 60, 100 years before us. The lessons are there. The second thing is to understand phases, and phase one is accumulation. This is Dow Theory 101. Institutions quietly build with lower volume. Emphasis on quiet. They do not want to attract attention. They don't want price to move higher as they're accumulating contracts or shares at a lower price. These sideways ranges is actually inventory building. Think of it as institutions, banks, funds building a position that they will later and happily sell to retail traders at highs. There's a phase two as well, and it's called manipulation. And again, this is straight from Dow theory. The spring, as Wyckoff would call it, or the liquidity sweep as it's now known, all stem from Dow theory. It's the false breakout, the whipsaws, and the general volatility that occurs when shares and contracts trade hands from strong to weak ones. Inducement, that enticement to make traders buy at higher highs or short at lower lows, leads to traps. The traps are then the stop hunts. These large orders need size. That is what stop hunts are. Don't be the hunted, act like the hunter. And you can once you understand these phases and these levels. The third phase is markup, which is just a trend. And again, Dow Theory 101. The real move begins after the trap. This is the pullback before the trend resumes. The sweeps at the new highs, trapping retail traders, chasing stocks higher, following news, and watching financial entertainment television. The displacement and the structure tends to break. And this is what oftentimes causes the panic. But in reality, it was just a trap. The character of the market trend can be really determined by two simple things. One, is it a trend? Or two, is it a chop? And the strong moves that entice traders to enter without a plan, only to see price move against them, that's a lack of understanding what structure they're in. If there is indeed a bullish market structure, the pullback after the sweep will follow through in the direction of that trend. So if markets were moving higher, there's a sweep, there's a pullback, continuation higher is the most likely probability. So why is this permanent? Why is this something I have so much confidence in that I have been doing it for 30 years and I imagine I'll be doing it for 30 years more? Market mechanics. They require liquidity. Institutions do not trade at new highs. Their clients want a good price with the best risk reward. They want to do so under the radar. The patterns work not just because of these market mechanics, but because human nature can be very predictable. Vegas knows this, and so does Wall Street. Cycles repeat regardless of the era. These patterns are not just decades old, some of them are centuries old. People do not change. Whether it was the tulip mania of the 17th century Netherlands or the dot-com bubble of the early 2000s, these patterns will continue to happen. Now you know the truth. Institutions need your stops, and they show you exactly where they'll take them. Most retail traders never figure this out, but you just did. That puts you ahead of 90% of the market if you actually use it. I dropped some resources in the description so you can start applying this with me in my live trading room. But if you want to skip the trial and error and actually level up fast, this is where my live trading community really matters. You get the direct feedback on your charts, you get the indicators that I'm using, you get to see my trade breakdowns and trade setups, and it's coming from someone who's been in the game for 30 years. I've seen these cycles. Making sure that you don't repeat the same mistakes and you improve your trading is the goal. Because 6 months from now, you're either still fighting the same traps or you're anticipating those reversals. You're waiting for the grabs, and you're trading with the real move and confidence. The difference comes down to guidance. Every pro you've ever heard of had a mentor. Even me, I had 3. Let that sink in, and I'll see you in the next one.